Let us look at this question, and this is full exams or likely exams question. A financial statement or financial position for three companies. They are Papa PLC, Mama PLC, and Baby PLC. So these are the financial position of the three companies. So you have property, plant and equipment, investment, inventory, strip receivables, and cash. So we also have the equities and the liabilities. Now let's go into the additional information. Additional information one. Papa PLC bought 720 million shares in Mama PLC on 1st August 2019. At all time, before you even start with the additional information, look at the financial year. So the financial year is what? 31st July 2021. So the accounting year begins at when? If financial year ends at 31st July 2021, the financial year begins at when? Hey,
1st August. I muted in 2029.
okay, that's fine. All right. So now, when you look at this, Papa PLC bought 720 million shares in Mama PLC on 1st August 2019 at the cost of what? 2 50 pesos per share paid in cash. Do you understand this statement?
Yes, sir.
What does it mean?
That we have to convert the shares into value
Thank you
and
very
then
much. Thank you very much.
multiply it by
That's fine.
the.
So on that date, the retained earnings of Mama stood at what? 480 million, right? And the net asset of Mama were equal to their carrying amount, except for certain items of property, plant, and equipment, which had a fair value of 350 million in excess of their carrying amount. Can you explain that to me?
Yes. When it's in excess, it means we are going to use this value, 320,
As what?
at the net assets
Okay.
column.
Thank you very much, Alex Asuria. Okay. Now, that's fine. So let's move to Papa has had a policy of carrying PPE at fair values. This policy is implemented across all group companies from the date of acquisition. Hence, the fair values were incorporated into the books of Mama at the acquisition date and the depreciation provided for appropriately. On 1st August 2020, Mama bought 520 million shares in Baby Limited. Do you understand?
Yes,
Have you seen that they've introduced another company in here?
exactly.
Good. Because Papa is the parent to Mama, because Papa bought Mama.
Mama.
Okay. Now Mama has also is having business deal with Baby PLC.
Mm-hmm.
Now,
Yes.
so the business deal
So
is that
there'll be indirect holding.
you understand, because Mama has bought Baby. Okay, 520 million, 512 million. The consideration for the purchase of us was 3 cedi per share in cash. Now, in addition, it was agreed that a further payment of what? 1 cedi per share will be made on what? On 31st July, which is how many years later? First, they
One
bought
year,
no, they
one
bought
year
the
after the fair.
okay. No, watch. They bought the Mama bought Baby 1st August 2020.
2020. So
And
2 years
2 years. Okay.
deferred.
Deferred. Now, the fair value of this component of our consideration was 320 million. Watch this. Have you seen what they've done here? The fair value of this
They've given us
component
the fair value.
of the company. So when you say fair value, I mean that is how much the arrangement values now. So here, the fair value of what of this component is 350 on 1st August 20. So it means that the purchase considered, they are talking about purchase. So the fair value of this component, which component? the purchase consideration. You understand? The further payment they are talking about is what? The fair value of it is what? 320 million on 1st August 2020 and 416 million on 31st August 2021. Have you seen what they are doing here?
And they are just tricking us.
Yeah. So you
Yes.
should pay attention to it. So all that they want you to know is that there is a purchase consideration of what? Of an asset. The asset or the payment arrangement, there's a purchase consideration. And the purchase consideration is going to be paid in 2022. However, the date that they are making the deal, which is 2020, the purchase consideration of that company was what? The fair value of that company was 300. It means they discounted the what? The purchase consideration. Year one is 320 and year two is what? That day, that means the year when they were making the arrangement, 2020, present value of what? Of the purchase consideration was 320 and the second year was 460.
Okay.
Because if you remember what we did under the hassle when we were doing purchase consideration, you will understand where this is coming from. The cash payment was recorded in the books of Mama, but no entry was made to record the contingent element of a purchase price. On 1st August 2020, the retained earnings reserve. You remember this? When we say retained earnings reserve, you understand it? So the date of acquisition, the retained earnings was what? 664 million under baby. And the revaluation surplus at what? At 360 million. You see, there's a revaluation surplus here. Baby has always had a policy of measuring property, plant, and equipment at fair value. Hence, the carrying amount of these assets were equal to their fair values at the acquisition date. Take note of all these. 5. Baby controls a famous brand name. Why start? The moment you hear brand name, what comes to mind?
Intangibles.
Intangible asset. I state it. So here, there is a brand estimated to have a useful economic life of 20 years on 1st August 2020 with a fair value as at the date of what? Of 40 million. You understand? So there's a brand. You understand? Under the baby, there is what? There is a brand worth 40 million and has useful life of 20 million. So when you are recognizing all the assets of what? Of the subsidiary, which is baby, you should take note of those assets. Now, Papa wished to use the fair value method to measure the non-controlling interest of Mama at the acquisition date. You remember that? You remember
Yes.
controlling interest? Okay. Now the
Yes.
controlling interest here, we have the share price of what? 2.5 million should be used for this purpose. You see, the fair value of what? It means when you are valuing the subsidiary, which is what? Mama. It means the NCI fair value of Mama is what? Is fairly valued at a price of 250 pesos. You understand? Okay.
Yes, sir.
Now remember, he didn't say anything about baby here. Do you understand? You say he didn't say when we were talking about controlling interest or fair value of what? Of Mama. He didn't say anything about what? Baby. So take note of that. It means Mama is fair valued. On 31st July 2021, goodwill was what? Was assessed for impairment and calculated show that the impairment of what? Of loss of 40 million will be recognized in the case of Mama and 20 million in the case of what? Baby. You understand? So goodwill is impaired. Now, during the year, Mama bought goods from what? From Baby, right? For total sum of 16 million. These goods cost Baby 12 million. You see, so there's intra-group transaction here. And the 60% of the goods remain unsold. What comes to mind? If some good left unsold, what comes to mind?
If some goods are left unsold, that is what we calculate PUP on it.
Thank you very much. That's all that I want you to say. So now they said that requirement. Prepare consolidated statement of financial position for the Papa Group for year ended 31st July 2021 in accordance with IFRS. Have you seen that with regards to the goodwill determination, Mama is fairly valued. Non-controlling interest is fairly valued. But when it comes to baby, they didn't say anything. What comes to mind here also?
And then that one, if they didn't say anything, it means we have to use proportionate.
Thank you very much. So clearly, if you follow this strategy, you can qualify. You can write and pass. Okay, so that is it about this question. Okay. The name of the company is what?
Papa Group.
Okay, so they say we should prepare statement of financial position, right? Okay, so you
Yeah.
start from here. So what do you do? I said when you are writing, how do you caption it? You say
Consolidated
consolidated what? Statement.
statement of financial position.
Statement of financial position as at the year ended.
They
Thirty
said
first, thirty
the
first
first
of
July,
July.
July 2021.
Then please you go in the what? Just follow the process of. Then you go into the what? Into the system of financial
Note
position. Then you
giving.
list. So
Yeah.
first one is what? Non-current asset, right?
Yes, sir.
Now non-current asset. First item is what, please? The first item is PPE. All right. So please you should write it in full. So property and what? And equipment.
Equipment.
So the parent, how much is the parent?
3888.
Property, plant, and equipment is how much? The parent is how much?
3888.
3888, right?
88.
Okay. Now, what you have to know is that after we've read through it, right, you can confirm that all the two companies can be what?
Can be added on.
Can be consolidated, right? So you'll bring them.
Yes.
So first one, 3888. And Mama is how much?
Mama is 1680.
1580. And baby,
16. 16.
okay.
80.
All right.
Baby.
Baby is how much?
1224.
1224. All right. So this is how they will look. Then let's move to the next item.
Investment, sir.
Investment. All right. So investment, what do they have?
3560.
3560. Okay.
2600.
2600.
200 Ghana cedi.
And 200 Ghana cedis.
No, 2600 plus 200 Ghana cedi.
Okay. Like this, right? Okay.
Yes, sir.
That's fine. The next one is what? Don't close it. You open it like that. The next one is what?
Current asset.
Then you leave a space here. You can call it
The
what?
goodwill will
Goodwill.
come.
We put it in bracket working. So this one usually is works number what? Number 3, right?
3, sir. Yes, sir.
Then you close it. Okay. So let's move to current assets. Mention them.
Inventory, sir.
Inventory. First one is inventory.
Yes.
Okay. Let's go.
1080
1080.
plus 368
368.
plus 300.
300. Okay. The next one is what?
Trade receivables.
All right. Trade receivable. Okay. Mention them.
1376.
Okay.
416
416.
plus 100.
Okay. The next one.
Cash.
Cash. Mention them.
368
Okay.
104.64.
Okay. The next one.
The next one, go equity.
Okay. So we have equity and liability. Okay. So under it, you have your equity. And remember, I told you that the equity, what you have, all the equity will be the equity of what? The parent, right? Okay.
Yeah.
Okay, so how much is the equity of the parent?
4,000.
Equity of the parent is 4,000.
Yes, sir.
So 4,000. You enter that one alone. Yeah. Because because in the question we didn't see any share exchange in the question, right? If there's share exchange, it will have been added to the equity. You understand? So since the purchase consideration, there's no share exchange, the equity of what of the parent will remain same. Are we okay? So which is
Yes.
4,000. Okay. The next one is what?
Revaluation surplus.
Revaluation surplus. Oh, under the equity there. I think let me make it share capital, which is what 4,000. Okay, so you said equity is what? Revaluation surplus.
Revaluation.
You will leave it.
The first value
You
is
will leave it.
40.
Don't add
You
anything in
yeah.
it. Don't add anything
Uh,
there. Leave it.
yeah, you are going to calculate it.
Yes. So also work on the next one is what?
Current liability.
You don't have retained earnings in it, eh?
Retain earnings, please. That is working number 5.
Working number 5. Okay. What again?
Then we are done.
Okay, then let us
NCI
consider
will come.
NCI. Good. NCI. Okay. Don't make it non-controlling interest. Write it full. Okay.
Thank you.
Non-controlling interest. That one is working number what?
No, that
Working
is
number.
2.
No, that one's at the working number
No,
4.
no,
4.
4.
Yeah. Okay, so let's go to liabilities. Is it long or short-term liability?
We have short.
We have short. Okay.
Yeah, so
So current liabilities. What and what can you mention?
we have payables and
Payables,
tax.
trade payables. Parent
Parent 1144.
1144.
Mm,
Subsidiaries
1080.
180.
Last one 56.
56. Then the next one is what?
Taxation.
Taxation. Okay, I'm listening.
Taxation 1296. Followed by 1128.
Okay.
Followed by 32.
Okay. Then the next one.
Then the next one is we are done.
Okay. Now, in the question, you remember that they said there's a deferred consideration in the question, right?
Yes.
You'll bring deferred consideration here. You remember in the question they said that there's a deferred consideration in it, so you will leave it like this, right? Okay.
Yes,
So
sir.
this is what you will prepare. You will prepare like this and put it down, right? Even if you do this and you didn't do anything, trust me, whatever you've done there, they will mark some. They will mark them.
Thank you.
Good. So when you are done, then you come here. You come and start your workings.
Then we start with
No,
acquisition date and those
no.
things.
Start
That
with
we
what?
will do.
Start with what? Accounting year
Okay.
of the company. The accounting year is what?
31st July.
Go to the question. It is there. 31st July. All right. 2021. Right. Now, then you also look at acquisition date, right? So acquisition, very, very important. Acquisition date of mama, right? By
Yes, sir.
papa. Give me the date. Go into the question, you will see
By
it there. By papa. When was it acquired? Check it here.
1st August
Thank you very much. 1st August
2019.
2019. Good. Then acquisition date of what? Of baby by mama. In the question, check it. It is there. What can you see?
Acquisition date by mama.
It is there. Look at I.
Then The third one by Mama. That is 1st August 2020.
2020. Okay, so this is what you have.
Yeah.
So this one will give you the fair idea. So when you list this one, so when you are whatever you are doing, then you can easily go and refer it, right? Okay.
Yes,
Now,
sir.
when you are done, then now you start with your first one. What do you do?
First one, we start with control structure.
Control structure. Now, the control structure, you look at it. When you look at this type of question, is this single or simple consolidation or complex group?
This is complex group.
Okay, because
We have indirect holding.
okay, so if so, then you come here, you say that Mama, you bring Mama first. Mama was first acquired, right? Then you bring baby here. Good. Then you start with what? Your parents. Parent is what? Is the papa, right? Okay.
Yes, sir.
Now, papa acquire, how much did papa acquire Mama? It is in the question. Let's go and see it.
Uh,
How much did they acquire papa? How much was acquired?
720 million shares.
Good. So it was acquired 720 million shares. Okay, so that is how much, that is how the acquisition was done. All right, so this how, so you better, so you have your what, your papa, your parent here. Now the acquisition of what, of this one, of Mama, was how much? This is papa. So it acquires 720 million, right? Right. Overall,
Yes,
what
sir.
is the total? What is the total share value of Mama? You go into the question.
1200.
So you go into the question 1200. So you should be very careful here. Have you seen that this is 1200 is what is the actual value? It is not in shares. You understand?
Sure.
So here,
Sure.
before you do that, you have to first what, convert all share values into what, capital values into what, into shares. So how do you do that? All you have to do is that, okay, you say that convert capital values into shares first. So here you pick share capital. The first one is what, is who, Mama. So the share capital was what, 1,200. Check it. The price of the share is what, is 1 cedi, right? The share capital is what, 1,200. The price is 1 cedi. So if to share convert it into shares, what, how do you do it? You will pick what, 1,200 divided by 1. That gives you what, 1,200, right?
The same value, sir.
Okay, so that is, so now you converted into share. You see, I'm drawing your attention to this because sometimes they will hide the trick in the question for you. You'll see that they will place 0.5 pesos. That's how much they bought it. When they put it that way, when you go and pick the same value and come and work it out, you will get it wrong. So at
Sure.
all time, ensure that what you convert it into what, into shares before you work it out. Now that we know that the total value of Mama is 1,200, when we multiply by 100, what do we have?
60%, sir.
Okay, so the parent acquired 60% of what? Of Mama.
Mama.
All right, so since there is an indirect acquisition, you, as you say, this is complex group. You know that Mama belongs to Papa. Now, Mama has also gone ahead to what? To buy baby. So there's indirect acquisition. You understand? Okay, so you bring what?
Yes,
Indirect
sir.
here,
Holding.
right? Good.
Indirect holding.
Indirect. So
Yes.
here will become what? Non-controlling interest. So now that we know that this one, Mama is what, 60% for parents, then the NCI for Mama will be how much?
40, sir.
40%. So when you add it, it should give you 100%. Now let's come to the indirect acquisition here. Right now, when you look at it, Mama acquired how much of baby in the question? Check.
512 million.
Okay, so 512 million shares. All right, so let's go in there. So that one to indirect acquisition is what? 512. Now, this 512 was acquired by who? By Mama from baby. So now that you know that one, let us go into the question and then check the total shares of what? Of baby as acquired by mama. You understand? So let's go into the question and check it out. Baby holds how many shares? That one to what do we do? You go and then convert that one to. So what do you do? As earlier indicated, you come here, you'll bring your what? Your share capital, baby, which is 640, and then share price is what? 1 CD is in the question. Please, can you confirm that? So convert it into
Yes.
shares. How do you convert it into shares? You have 640 divided
640
by 1.
over 1.
That gives you what? 640,000. Okay. So that's the total number of shares of what? Of baby. So we divide it by that 640 times 100. What do you have?
80%, sir.
Now, 80%. This 80% is indirect what?
Holding, sir.
Is how much mama acquired in what? In baby. Now that mama belongs to the parent, this company indirectly belongs to what? To the parent as well. So what do? You also, since you own mama, you need to acquire. You are coming to consolidate it. So it belongs to you now. So how do you get the percentage difference here? So all you have to do is that you pick how much mama bought in what baby, which is 80. Then you multiply by how much the parent own in what? In mama, which is 60. That gives you how much?
48, sir.
So that gives you 48%. So now the parents have stake in baby 48%. Now, what is the NCI for baby? Now, what is left is for baby. How much is left for baby?
52, sir.
52%.
52,
Thank you
sir.
very much. So when you add, you have 100%. This is a very good mark. Group structure, they will mark you and give you mark there. So don't lose sight on also group structure. Now, as earlier, the last time I told you, somebody did this. And he realized that the parents' percentage in baby is 48%. So for that reason, he said that he will not consolidate baby. He will only consolidate mama. Is it correct?
It's wrong.
Thank you very much. All right, so let's move. The next line of action is to do what?
We are going to 2, and 2 will give me net asset
Thank
of
you very much. So you
mama.
pick mama. So mama and baby. So first, what you do is that you come here, you say what? Net asset of what? Mama PLC, right? Of mama. You first find mama, and you can also find net asset of what? Baby, the subsidiary, right? So this one is subsidiary, and this one is what? Subsidiary. Know the difference. You understand? You will bring the distinction like that. So here,
Yes, sir.
you will bring your what? Your at acquisition.
At reporting.
Good. So at reporting and then post acquisition. Okay. At acquisition, at reporting, post acquisition. Right? Okay. So what do you do next?
Yes, then we go to the
Consider the mama
statement given.
first. Good. So first you consider work on mama first. So you go into the statement of what? Financial position, and let us look at mama equity. So the share capital of mama is how much?
120, sir.
So 120, which is 1,200. So you come, you say
At
share,
reporting.
okay, share capital 1,200, right? And at
Yes, sir.
reporting is also will remain the same, right? 1,200. Question didn't
Yes,
see
sir.
anything else. So here, when you will let it, here will be what? 0, right?
0.
Okay. Now, what about the next item? What can you see there?
Revaluation surplus, sir.
Revaluation surplus. So revaluation. How much is the revaluation surplus?
We have 960 at
Nice.
reporting.
Okay, so 960. Watch here. In the whatever you see in the what? in the statement of financial position is at reporting, which is what? 960. Have you seen it?
960, sir. Yes, sir.
Aha. So revaluation surplus is 960 for this. Now you go into the what? You will go into the additional
Into the
information.
adjustment.
So did they say anything about what? Revaluation surplus about the mama? Now go into
Yeah.
the first paragraph. Read.
The first paragraph, we are told that Papa bought this amount, 720 million shares in Mama.
No,
On
go to second sentence of that.
second sentence, on that date, the retained earning of Mama stood at 480 million, and the net assets of Mama were equal to their carrying amount, except for certain items of property, plant and equipment, which had a fair value of 320 million in excess of carrying amount.
You understand? So here they are talking about this money, this asset. So here, obviously they've told you that there's a revaluation. So when we say something is excess, so what they are talking about is PPE. You understand? So they want
Okay.
when they say PPE is in excess of it what of it carrying amount. What does it mean? That there's a revaluation what gain on the asset. You understand? Now, when there's a revaluation gain on an asset, where does it go? It goes towards the
In the
treatment.
first
You
time, it
understand?
will go to
It will go to
P&L, but
it will go to
subsequently
OCI.
OCI.
You see, if you go to OCI, already that asset has already increased the value of what of the PPE at the debit side, right? So when it goes to OCI, then it will come to what equity. So when it comes to equity, that's where you have your what your revaluation what surplus or reserve under the equity. So that is what you are seeing here. So all that they are telling you is that they already have revaluation of what of asset of what 960,000 at reporting. That means when they were acquiring the assets, the revaluation. So when they were acquiring the asset, what did they say? They told you that there was an asset which has already have what fair value of 360 value in excess of its carrying amount. So what do? You will bring it here. That means there was a fair value of an asset of 320 when they were doing the when they acquired the asset. At reporting, the value of the asset has moved to what to 960. Do you understand this? Okay. So do you understand this, please?
Yes, sir.
So when you differentiate, what do you have?
Oh, 960 minus 320. 640, sir.
Okay. What access follows?
Retained earnings,
You have
sir.
your what? Your retained earnings. Okay, your retained earnings. What you see in the state of financial position is what at reporting. How much is it?
Retained earning is 800 Ghana
Your
cedis.
retained earnings is 800 Ghana cedis. It's 800. Now, let us look at the additional for if at the date of acquisition there was already existing retained earnings. Read on.
On that date,
Mhm.
the retained earning of Mama stood at 480 million.
Okay, that's right. So it means at the beginning it's for so at reporting is how much? Retained earnings
800,
800.
800.
Okay, so as you can see, so it's 800 here. And then at the beginning they say it's what 400 and what? As you read,
80.
480 cities. Okay, that's fine. So what do you have?
320.
320. Okay, let's move. Which item again?
Yes. Then we move.
Is there any additional info? Is there any asset that
No,
should
they've
come
not
here?
mentioned.
They've not mentioned. So let's look at I is talking about everything about revaluation on assets, right?
Sure.
The I is talking about the acquisition of new assets. IV is talking about control, and then it's talking about brand, and then V is talking about revaluation method. What do you call it? Equity method, and then six is talking about goodwill, And then seventh is talking about what? It's talking about intergroup transaction. So the issue regarding Mama is finished. Is that not the case? Is that not the case?
Yes, sir.
Okay, so now let us
Yes,
sum
sir. I
up.
can hear you. Loud.
Let us sum it up. Everything, there's
There.
nothing under Mama again. So sum it up.
It will give me 2,000.
At reporting.
Reporting 2960. 2960.
All right. Difference is how much? 960.
960.
Now let's look at subsidiary. So we start with also what? Share capital. Now, when you look at the share capital of subsidiary, the share capital is how much? 660, right? 640. Okay. So the
640.
so at reporting will be how much?
640.
At reporting will be also be 640.
40.
So here will be 0. Now the next item is what?
The next
Revaluation
item is
surplus.
valuation.
Okay, so the revaluation is how much?
400, say, at reporting.
So 400 at reporting. Okay.
Yes, sir.
So that's in the statement. So statement of financial position is what is 400. Now, so that's 400. Yeah. Now let's go into the additional information. What did they say? Go to the item III. What did they say? Come to
We
on
are going to
1st
Mama
August. On
on
1st August.
first August. The retained earnings reserve for 60 million. The
Okay.
bank has always had a policy of measuring property, plant, and equipment at
Okay.
fair value.
Okay.
Hence, the current value of this
Okay.
asset
Okay. So now
is equal
we know that it is what 360. When you less, what do you have? When you less, you get 40.
160.
Okay, so when you less, you get 40.
40
So the next one is what?
retained earnings
So you have your what? Your retained earnings. Okay.
at
So the retained
reporting
earning at reporting is how much? Check the system of financial position.
760, sir.
760. Now let's
Yes,
check
sir.
the additional information. What did they say? They said what? They said
They
what?
gave a value. Retained
Retained
earnings
earnings reserve is how much? 664, right?
664.
Okay, 664. Now, when you find the difference, what do you get?
96, sir.
96. Now, let's go in there. Is there any, go to the same place? Is there any additional information they want to talk about?
Bebe has always had a policy of measuring
Measuring
property,
property,
plant,
plant, and equipment at fair value. Hence, the carrying value of these assets were equal to their current. That's fine. So, come to the IV. What did he say about IV?
Bebe estimated to have a useful life of 20 years from 1st August
Thank you very much.
2020
So, that is
with a
brand.
fair value at the same.
So Baby has a brand called Y Start, right? So since it has Y Start, as we are considering, we add it to the net asset of what Baby. You agree? Do
Yes,
you
sir.
agree? Good. So here you have what brand. So the brand is what 40 at reporting and 40 at what at acquisition at 40. So when you let it, you have a 0 here. Now
0.
there is what? There is depreciation on this brand. So this we because it is intangible asset, we call it what? We amortize.
Amortize.
Right? So how much do you amortize? They've given you what? 40 of the asset, and they said that this asset is what? Has a useful life of how many years? 20 years. Do you understand?
Yes, sir.
20 years. From 1st August 2020. When are we consolidating this?
We are doing it 1st August 20. Let me see. Say we'll go. Consolidation is 31st December 2021.
31st July or December.
Hey, July, when we started
So the
consolidating.
amortization, they're giving us what? 20 years. And they said
Yes, sir.
that when they acquire the assets and the useful life start from where? 1st August. So if 2020, an accounting year ended in what? 31st July 2020. How many years?
And then it's going to be only 1 year.
So 1 year, then you multiply by 1. The amortization, I've already told you, it's calculated at the end of the accounting, right? So when you do, what do you have?
So reporting, we take it to reporting.
So this one is how much?
2.
So it was 2, eh? So
Yes,
2,
sir.
and then 2 here. Right? Okay. Now
Yes, sir.
let's move. What again?
They said something which I want to
Okay,
understand.
so you analyze, you go through it. You look at Vin is talking about combination or method of what? Combination, yeah. VI is talking about goodwill. VII is talking about goosebumps. So this is where intergroup issue comes in. Read it. VII. So here, what can you see here?
VII. During the year, Mama bought goods from Bibi for a total sum of 60 million. These goods cost Bibi 12 million. 60% of the goods remain unsold by Mama at the reporting date.
Have you seen what they've done here? So here,
Yeah.
what can you see here? So clearly, here, this is what they are talking about. They are talking about intragroup transaction.
Okay.
So intragroup transaction here. So here, there's what? There's who sold to who?
Mama bought from Bibi.
So
The
mama
sub
bought from,
sub
so
sold
baby
to the
sold it.
sub.
Okay, so baby sold the goods to what? Mama, right? Okay, so baby sold goods to what? Mama. What amount did he sell? He sold what? 16 million. Have you seen that?
Yes, sir.
Now, this is what they sold. Well, when you read the question for further, it said that these goods cost baby 20 million. What does it mean? It means that the selling, so 16 million.
No, sir, let's go back. It's not 20. Oh.
No, listen, I'm saying 16 million, right?
Okay, okay,
Selling
okay.
price, selling price is 16 million, and
Sure.
cost
It's
was what?
12 million.
12 million. Have you seen that? So that is what you can see that. So here
Yeah.
our interest is what. So how can you get the what? The profit margin from it is how much? So you realize that the profit is how much? What is the profit?
4 million, sir.
4 million. So the profit is 4 million. So this becomes what? Unrealized profit. Have you seen it?
Yes, sir.
This becomes what? Unrealized profit. So this is what we are looking for. Have you seen how they also count this question? So you should be very careful. Sometimes that's how they do ours. So this becomes your unrealized profit. And in the question, what did they say? They said that 60% of the goods remain unsold by Mama at the reporting date. So now we know our
Yes.
unrealized profit. We know our unrealized profit what to be 4.
1 million.
You understand? We know our unrealized profit what to be 4. So how do we get our what? Because we cannot bring all the 4 here as a provision for unrealized profit. Because the question says that out of what? Out of the goods sold, 60% is what? Is
It's
unsold.
not sold. So it means
You
we
understand?
multiply 4. We
Uh-huh.
multiply the 4 by 60.
Absolutely. You understand? Aha. So here, if you want to, so this has to it will be what? 60% multiplied by 4. That gives you how much?
2.4, sir.
2.4. So this is your true PUP. Because if they said that 100% of the goods remain unsold, then we would have
We
used
use
all
the
the
4 million.
four. You understand? But since they said
Thank
that
you.
it's only 60% that remain unsold, that means when you pick the 60% of unsold goods, the unrealized profit will also be 60% of that. So that is how it should go. So what do you have here? So you have your what? Your PUP, provision for
PUP.
unrealized profits. Here it's always at the end of what? Accounting year. So here is what 2.4 here. And here we got 2.4. Right? Okay, so I think that is all about this one as well. So please do the mass.
Okay.
Sum them up.
At
Okay.
acquisition, 1704.
Okay. Uh-huh.
At reporting,
Uh-huh.
1835.6.
Oh, okay. Then you less the two.
So post acquisition 131.6.
Oh, okay. I wanted to also show you some trick here about this same intergroup
Thank
transaction. Watch here.
thank you.
Watch here. they said that 60% remain unsold. Okay. In all, let's look at it. In all, how much was sold so far? Total sales was how much? 60 million. And they said that 60% remain unsold, right?
Okay.
Is that not the case?
Yeah.
So 60% remain unsold. So when you multiply 60% by the 16, it will give you the total unsold goods. What do you have?
Okay.
So unsold goods.
16. 16 times 60%. 9.6.
9.6. So this remain unsold
Yeah.
goods. Do you understand? And then they gave you cost of the product. How much is the cost?
The cost is 12.
12 million, right? So this is
Yes,
unsold
sir.
goods. And this is what? Cost of the what? Of the goods sold. So the difference will give you how much? That gives you what? That gives you what? Unrealized profit. How much?
2.4, sir.
2.4. Okay. The same. All right.
2.4, sir.
Yes, so that's all. The same thing, right? Okay, good. So the next one is what?
From here, we go to goodwill.
Goodwill. Okay. So the goodwill, mama, right? This is S. And then goodwill, baby, who is SS, right? Okay.
Yes,
So let's start with what? Purchase consideration.
yes, sir.
Purchase consideration of what? Mama. Let's go into the question. What is the
Ma-
purchase consideration of mama? How much did they say they sold mama? Watch here. They said that it is what? They bought 720 million at what? At a cost
Shares.
of 2.5. You see, they didn't give you direct money, but they gave you unit
Yeah.
price. You understand? So clearly it is, and they say it's in what? In cash, right? So here, cash. You will pick. How many shares did they buy? 720.
720.
Multiply by this unit price of the share is how much?
2.5.
2 CD, 50 pesos. So when you multiply, what do you have?
180.
Okay,
1800.
good. So now, is they apart from cash purchase, did they use any form again for the purchase of mama?
No, 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 no.
So you
No,
go
no, no,
through it. So
no.
I think before they exhausted all the information. So mama was only buy with what? With cash. Okay. So now let's go. Please, should we use the option 1 or option 2? It's in your court for determining the good one for mama. And you know that mama is fair value, right?
It's fair value.
Is mama fair valued? Is mama fair value?
Mama is fair value. Yes, Mama is fair value.
Mama is fair value, right? Okay. So because mama
Yes,
is fair value, so that means we will use fair value method, right? So when we look at it,
yes,
come to V. V says that Papa used to use the fair value method to measure the non-controlling interest of mama at acquisition date, right? So it means mama is fair value. And they're giving you what? Share price of what? Of mama to be 250 pesos. Okay. So
yes.
here, you say you add NCI what? You add NCI fair value. Is that not the case? And in this case, they didn't give us in value the what? The NCI of fair value. So we have to go and look for what? We have to go and look for it. Is that it?
Okay.
You have to go and
Yes,
look for
sir.
it. Now, so how do you look for it? You can use two methods to look for it, right? So what am I saying? So here, you can come here.
Yes.
You can use two methods to find for it. So here, you can come here, watch here. Mama, total shares of Mama is 1,200, right?
Okay.
Papa acquired out of 1,200. How much did Papa acquire? Papa acquired 720
720.
out of that. So how much share left here out of this? How much share left?
480, sir.
480 shares left. So this belongs to what? Mama now. Do you understand? This belongs to Mama now.
Yes.
Or you can say that, okay, you will bring all the shares of what? Of Mama. How much? Mama share is 1,200. Now Papa
Yes.
has acquired Papa has acquired 60% of that. So you are less of what? Mama with how much? 40%.
40.
So when you pick 1,200 multiply by 40%, that gives you what the total share for what? For mama.
Okay.
You understand? When you multiply, what do you have? So it all boils
1,200.
down to how you want to go.
The same.
So that's it. So now you know this. So now you can now find the what fair value of what? Fair value of what the subsidiary. That's NCI. So you come here, you can choose to pick 1,200 multiply by the stake left for what for the pay subsidiary. And you multiply by what? The share price, which is what 2 cedi 50 pesos. You understand? So when you multiply, what do you have? Well, that's what they said, 2 cedi 50 pesos. Okay, so when you multiply, what do you have?
1,200.
1,200, and they say you should what? You should add NCR favor. When you add, what do you?
3,000, sir.
3,000. All right. So this is 3,000. Then you say that you less what?
Less
Net
the net
assets
assets
at what?
at
At
acquisition.
acquisition of mama. So you go there, check the net asset of mama. How much is the net asset of mama at acquisition? It's how much?
2,000.
2,000. Have you seen
2,000.
it?
Yes,
You
sir.
can highlight these ones. They are very, very important. So 2,000. This one is 17.4, right? You said it was 17.04, right? Right? Okay, so I've highlighted that. Okay, so that's net asset at acquisition. So 2,000. You will less it. So when you less it, what do you have? When you less it, you have 1,000. Is that not the case? Is there any impairment on this asset?
Let's go to VI. On 31st July 2021, goodwill was assessed for impairment, and the calculation showed an impairment loss of 40 million will be recognized in case of mama,
Okay.
and 20 loss has been recognized in the
In case
year.
of baby. Okay, that's fine. So yeah, it means mama is impaired. So you say what? Less impairment, right?
Impairment
All right. So the impairment is how much? 40.
40 million,
So when you less it, please give me the value.
960.
All right. So 960 is goodwill for what? For mama. Okay. Now let's go to
Mama.
baby. Let's go to baby. What is the purchase consideration for baby?
Yes,
So you
sir.
come here.
That is III.
So let's go to purchase consideration for baby. So here, this one too, III. So they said that it was also bought 3 cedis per share. At what? How many shares did they buy? How many shares did they buy?
They bought 512
512.
512 million.
Good. So that one too is cash. So here, that
Yes.
one is what? 512 million multiplied by 3, right? Series. So when you multiply, what do you get?
1536, sir.
Okay, so 1536, right? Good. Is that the only mean they bought this asset? In addition,
It was agreed that a further payment of 1 CD per share will be made on 31st July 2022.
good. Well, that's what we refer as what?
Defer.
Deferred. And remember, watch here. They said the fair value of this purchase, the date when they bought the asset was 320 in July in 2020. And in 2021, the fair value is what? 416.
416.
Do you understand? So there's a meaning of this. So here, the deferred consideration is this. The date where you see we calculate deferred consideration. When do we calculate deferred considerations? So when you buy, listen, when you buy purchase date of what? Date of acquisition. So the date of acquisition is maybe 1st January 2024, right? And you say you are going to pay in a later year, maybe 2 years time. That is the very day that you calculate your what? Your discounted or present value of what you wanted to buy. You understand? So assuming you want to defer payment of maybe 3 million. You understand? The day that you acquire the company, right, is the same day that you have to calculate for what? For deferred payment of what? Of the 3 million. You understand? So if you defer the payment, right? If you defer the payment, the day that you calculate, if you calculate and then the payment amount is maybe the present value of the payment of 3 million will be what? 2.6. Do you understand? This is what you work out. Well, this is what you work with for the year one.
Sure.
Aha. So the same thing happens to the company, this very company, right? So when you look at this very company, baby, they said they are going to pay it in what? The payment is going to be in what? In 2 years' time. That's 2022. You understand? So the very day that they what calculated the present value, the fair value was 320. The year two, for the second year, 416, and the final year they will give you what? Another value. Do you understand?
Uh,
Do you
yes.
understand? Because when you look at this instance, if assuming the payment, just like what we saw here, assuming this is a deferred payment of 3 million and the cost of capital is maybe 10%, right? And the year they are going to pay is what? 3 years' time. You see, every year you can calculate for what? Every year you calculate for present value. Year one, present value. Year two, present value. Do you understand? So you have year
Yes.
one, year two, and year three. You understand? So that is what. So you see, if you calculate year one and you assuming you have 2 points, maybe 4. Year two, you calculate you had what? 2.6. Do you understand? And year three, you calculate you have what? You had 3. You calculated you had maybe assuming 3 point maybe 8, 2.8 like this, right? So I told you that when that happens, the difference between year one and year two will give you what? Unwound discount.
0.2.
Are we forgetting? Unwound discount.
Yes.
The difference between year one and year two will give you what? Unwound discount. Unwound discount. You understand? Aha. So you take note
Yes.
of that. So yeah, the deferred payment, the fair value at the date that they did the deferred payment calculation was what? 300 and what? 20 in the question. Have you seen it?
Yes, sir.
Good. So that's all. So when you add it, what do you have?
1856.
1856.
Yes, sir.
Right? And remember, this is what? Baby is what? Subsidiary. So if it's subsidiary, then we have to do adjustment to what? To this very value because it's not directly owned by the parent. We have to remove the portion of what? Of the subsidiary from it. I
Yes.
showed you 2 options of how to get it. So give me which option do you prefer us to use in this instance?
I'll prefer the first option.
The option 1. So if you are option 1,
Yeah.
then what do? You say what? Indirect
Holding.
holding what? Adjustments. Now, the indirect holding adjustment, what do? You will pick, right? What do? You will pick this value. How much is that value? That value is what? 1856, right? Then you will multiply by what? By the parent percentage in what? In the subsidiary, which is how much? Indirect, when we are doing indirect
60.
holding adjustment, wove around the what? The parent percentage to work on this. Not the percentage in subsidiary. No. The parent percentage in the subsidiary.
Thank you.
So which is what? 60%.
60. Yes, sir.
So when you calculate 60%, what do you have?
111 13.6.
1113.6.
Yes, sir.
Right? Good. So what do we do next? Now we know our true purchase consideration to be what? To be this.
So the next thing we do from there, since we are using the parent,
No, listen very
this
carefully.
thing.
What you should also know is that baby is not fairly valued. So which method are we using here?
Proportionate.
You are using proportionate method. So it depends on what you want to do. Do you understand? Which option will you use?
Thank
If
you.
you are using the proportionate method, which option are you going to use next?
Yes, sir.
Good. So what do you do next? You are using proportionate method. So we have two methods. Which option do you want to apply?
I want to use option 1.
So if you are using option 1, then all you have to do is that you say that you will less proportionate
Thank you.
of what? Of the parent, proportionate of the parent at what? At acquisition. So here, all you have to do is that you pick the at acquisition. What is the at acquisition for what? For the baby? It's how much? 17.4, right? Have you seen it?
Yes.
17.4.
Yes.
So you pick 17.04, right? Multiply by what is the percentage? What is the percentage of what? Of the parent in baby? Do you understand? The percentage of what? Of the parent in baby is how much? Percentage of the parent in baby is how
That is
much?
a 48.
Thank you very
48.
much. 48%.
Yes.
Right? That's 48%.
Yes, sir.
So when you multiply, what do you have?
817.92.
817.92, right? When
Yes.
you less it, what do you
Yes, sir.
have?
295.68.
29.
5.68.
Okay. So there's what? There's you less impairment. There's impairment. Impairment is how much?
Impairment of that small one is 40, one is 20.
20. So this one is 20. You less it, what do you have?
275.68.
Like this, right? Okay, so this is your good one. Now, have you seen this proportionate method that we just did? Have you
Yes,
seen
sir.
this proportionate method? We can do it differently, like this.
Thank you. Alternative.
Yes, we can do it differently like this. Assuming we've calculated our purchase consideration, everything. So you have your what? Your purchase consideration. So our purchase consideration, we have what? Our cash. The cash was what? 536. Our deferred consideration was how much? 320. You add it, we
2320.
have 18.56. And we did what? Indirect holding adjustment. So when we did indirect holding adjustment, you said what? 18.56 times 60% of what? Of the parents in the what? In the subsidiary, you had what? 1113.6. Now you had this. After you had this one, we are going to work with this one. This one we are done with it. Do you understand? Now, after you had it, you can say add proportion of what? Of the subsidiary. Proportion of the subsidiary and the baby is how much? You understand? At net asset at what? At acquisition. Proportion of net asset, the net asset at acquisition is how much? Is 17 0 point what? 1704, right?
Yes, sir.
Aha. Then you multiply by what? Proportion of what? Of the subsidiary. Go here. Baby. Baby is a subsidiary. Under the I'm talking about the baby. Follow me keenly here. Baby is a subsidiary. Have you seen them? Have you seen the baby is a subsidiary? Then I'm talking about the baby
Yes.
percentage. Aha. So 52%. You add it. You use that one to multiply. Times 52%. What do you have? What?
886. I
Eight
had
eight.
886.
Aha. So you add it. When you add it, what do you have?
1990.6. 1999.6.
Okay.
So I was approximating it.
No. You know it. 1999. 1990.
1999.
So it's
Okay.
less net asset at acquisition. So what is the total net asset at acquisition?
At acquisition,
1704.
net asset 1704. Yes, sir.
So when you less it, what do you have?
295.6.
Okay, 295.6. Then you less impairments.
So you're right. I think this one looks a bit simpler.
So this one gives you how much? 20. So when you less it, what
The
do you
same
have?
275.6.
Okay, all right. So all of them
Wait,
are what?
wait and let me copy. I beg you.
All of them will give you will give you the same outcome
Add proportionate of. Say add proportionate of what?
of the subsidiary.
Okay. Add proportionate of the subsidiary.
Now the fourth one is what? Non-controlling interest, right? Non-controlling
Uh,
interest.
non NC.
So non-controlling interest. This one is mama subsidiary. Non-controlling interest subsidiary. Okay, so let's move.
Yes.
Whilst you are at it, you should identify which one is what fair value and which one is what proportionate. Do you understand? Which one is fair value and which one is not fair value?
Mama is fair value.
Okay, so mama is fair value. So if mama is fair value, then you say what?
Yes, sir.
You say what?
Yes,
NCI.
sir.
You say what? NCI fair value. So NCI fair value, we know NCI fair value of mama. How much? Let's go into the NCI fair value is how much? NCI fair value of mama is how much? 2,000 or 1,200, sorry. Right? Then you say what? Share post acquisition profit. Let's go into the what? Net asset of what? Of mama. Post acquisition profit is 960.
NCI.
So
Yes.
960, then you will make what? 960 multiplied by mama is how
We
much
have
percentage net?
calculated
It's 40%.
1800.
Okay, so how much is it?
1800.
1800.
1800.
That's NCI.
Nine
That's
eight
NCI.
nine 960 times 384.
Okay, so you add 384. Now, there is impairment they have to share. So share impairment as well. Now, the impairment is how much? So when we look at it, the impairment is what 40 multiplied by 40% of what of the subsidiary. How much is it?
40. Yes.
How much is it?
16.
16. So you put it in brackets.
Yes, sir.
You understand? Are you with me? Now,
Yes, sir.
let us come and deal with this one. The unwound. The moment that you know that we have there is
Defer.
come again, sir.
Let's go on. Defer.
There's defer finance cost.
Consideration.
There's a finance cost on this asset. There's a finance cost on this asset. And this very finance cost, you understand? Watch here. Let me give you the difference between the finance cost accrued by. Watch here. There's a difference between this one. Let me show you this one. Assuming if parent acquired what? A subsidiary, right? And the forms of what? Of purchase or forms of what? Acquisition. There's a deferred consideration.
Yes, sir.
Well, if there's a deferred consideration, you realize that the deferred consideration will go to the what? Purchase consideration, right? Now, and there will be what? Unwound discount. There will be what? Unwound discount. You remember the last time when we were doing the other one, the unwound discount, where did I take it to? I take it to what? Retain earnings.
Earning.
Because it is what? It is who? It is the parent who is incurring this what? Finance cost, right? If it's not the finance, you have to remember.
But that's the parent this thing.
Yeah, because the parent who was
Parent.
acquiring the asset. So it's the
Yes.
parent who incurred this what? Unwound this what? Finance cost. You remember that? Now, here is the case.
Yes.
Here is the case. You have this is a situation that we find ourselves in. In this instance, there's a subsidiary here and another subsidiary. There's a subsidiary, two
Yes,
subsidiaries
sir.
controlled by what? Controlled by parents. Okay, so we have subsidiary here and we have subsidiary also here. Now, this subsidiary acquired this what? Subsidiary. Do you understand? So when they acquired, there was what? There was a deferred consideration in their what? In their dealing.
Acquisition.
Do you understand? So here, this subsidiary acquired this subsidiary, and when they were paying, there was a deferred consideration. So this deferred consideration, as you know, there will also be unwound discount. You understand? There will also be unwound discount. So who is going to incur the unwound discounts or finance costs in this instance? You understand? Who is going to incur that?
Acquiring the sub. It's the sub that is going to incur.
Absolutely. So it is a it's a subsidiary. Subsidiary will incur portion of it, and the parent will also incur because
Yes.
when you look at the earlier one, the 100% what unwound discount what will be borne by what by the parent. But he's the one acquiring it.
The parent.
You understand? But when you come to this one, when you come to this company, it is the subsidiary that's acquiring the subsidiary. So when there is any finance cost or unwound discount, it is what? It is the subsidiary that will incur the what? The cost. Do you understand? However, because this company subsidiary is also owned by a parent, they will share the cost of unwound discount.
Okay.
Do you understand? Because because this parent is also going to have stake in what subsidiary. So if there's any cost coming, they will share it. Are you with me?
Yes, sir.
So you put that at the back of your mind. Whenever there's unwound discount under the subsidiary, the subsidiary that acquired the subsidiary, and there's an unwound discount, they will bear some of the cost, and the parent will also bear some of the cost. So here, as I earlier indicated, there's a finance cost or unwound discounting because of what? Purchase consideration. So here, you will have it here. You understand? Because they've already calculated that the present value, year one was what? 320. Year two was what? 416. Check. It is in the question. Have you seen it?
Yes, sir.
So they've given it to you. It is deliberate. So if so,
Yes,
to find the unwound discount, you will find the difference between year one and year two. Let me take you to. Have you seen it?
Yes.
Have you seen? Watch here. Year one, year two, year three. They found the
I
discounted
told you,
factors.
horizontal man.
Absolutely. So
Yeah.
present value year one, present value year two, present value year three. So if you want to know the what,
And then we
so if you want to know the discount for what for the respective year one and year two, you'll pick year one, year two. It will give you what? It will give you on
the
one
difference.
discount, right? To be what? To be this. And then the second year three and year two will also give you, when you add it, will give you the total what on one discount. But in this case, only year one and year two. You understand? All right. So that is it about that. So yeah, they've given you two. So you have year 2416 minus what? 320. They are in the question. I said they will be shared
90.
between the parent and the subsidiary, and 40%, right? So when you multiply, what do you have?
38.4.
It is a cost. So 38.4, right? Good. This is a cost. So you put it in bracket. It's a cost. So you put it in bracket. Okay. The next one is what?
Indirect holding.
Acquired baby. Now, once they acquired, you remember that we did what do you call the adjustments, right?
Okay.
You remember that we did indirect adjustment in the what here. You remember this adjustment? Have you seen that we did this adjustment?
Yes.
So that means we want to own the indirect the parent want to own the what the subsidiary. So that's why we eliminated the shares or what the subsidiary has with the baby. So we work it out. Do you understand? You remember that the last time
Sure.
I told you that when you are done, then you come to also the subsidiary. You understand? You did this one, this thing that we did here is in what? In the subsidiary that we calculated this. Right? When you are done, then you come to non-controlling interest. Right? So you will say what? The indirect what? Adjustment. The indirect holding adjustment. Indirect holding adjustment is going to be what? You will pick the what? The total shares, the total purchase consideration. How much the total purchase consideration in what? In the subsidiary. Have you seen it? This one. 1856. You will pick it. 1856. Then you multiply by what? You multiply by the shares or the percentage share in what? In the subsidiary. You understand? So the subsidiary is how much left? 40%. Like this. Then you multiply that one too. You've forgotten, eh? You remember that yesterday I gave you two options. So you have
Yes.
1856 multiplied by 40%. What do you have?
742.4.
742.7.
4.
Okay.
Sure.
So when you are done, then you what? You less that one too. You add it. So remember yesterday I told you, or I said this, that when you come here to, we have also two options here. You remember this one? I told you that purchase consideration to them.
Yes.
We also have two options for adjusting the what? Indirect holding to arrive at the same goodwill as well. You remember I told you that? He has forgotten. I told you that
Yes.
instead of you calculating 60% on 856, calculate the percentage of what? Of the subsidiary, which is 40%. That's what I said. Option 2. Watch here. Have you seen it? Have you seen it?
Sure.
Watch it here.
Sure.
Less indirect holding adjustment. You see, I calculated the 20% of subsidiary. Have you seen it? So
Yes,
if NCI is not fair value, then I will what? I will do what? Less net asset at acquisition. But here NCI is fair value. So they added it before they less the net asset at acquisition. And they arrive at the same answer. You understand?
Sure.
So the same thing that this is option 2. That's the index. So when you calculate like this, you will just pick this one and send it to non-controlling side of the subsidy, then you will less it direct. Right? But with this one, it's easy for you to just pick it. Otherwise, if you pick the first option just like this one, there is the option 1, as we did. There is the option 1. Where is it? So there is the option 1. So I just picked the purchase consideration, multiply by this parent, and I arrive at it. Then I added the NCI. Right, then I less the what? Net asset at acquisition. I arrive at what? At the good one. So we use the option 1. So when you use the option 1, when you go to NCI of what? Of the subsidiary, then you pick the subsidiary percentage, then multiply by what? By the total purchase consideration, then you will less. Do you understand? Okay.
Sure.
So when you add it, what do you have?
I had 787.2.
Okay, so you have 787.2.
Yes, sir.
Okay, so we are done with what? The subsidiary. Let's go to a sub-subsidiary. Sub-subsidiary will be treated the same, what do you call it? Normal. So that one, you will pick NCI. You know this one, NCI fair value. You know this one, the sub-subsidiary is not fair value. So we use what? We use proportionate method, right?
Yes, sir.
Then remember what I told you about it. I said that when it is proportionate method, just pick what? Fair value. Pick fair value at reporting. Remember.
Okay.
So when you
Yes,
pick
sir.
when you pick at reporting, what do you have? You will have what? Go to the at reporting of what? Subsidiary. How much is it? How much is it?
NCI fair value.
So
1835.
1835
35.6.
0.6. Okay. Then you multiply by what? Baby is, what is the percentage of baby? The subsidiary. What is the percentage of baby subsidiary?
52.
52. Okay. So you have 1835 point what? 0.6 times what? 52%. What do you have?
954.5.
954 point what? 0.5, right? Remember, you know that baby is also impaired.
Yes.
There's impairment here. You remember? Goodwill. Have you seen that
Yes.
goodwill is impaired? How much is impaired?
20.
20. Are we going to share this one too?
Yes, we share.
We will not.
Why?
You see, you are taking notes, but you don't revise. I told you over and over and over and over again that when you are using proportionate method, when you are using proportionate method, right? When you are using proportionate method, and there is
Yes, sir.
and there is impairment, don't share the impairment with what with the subsidiary. Do you understand?
Thank you.
Because watch here,
Thank you.
we've already even used the word at reporting to even get our fair value. So what I said that you will apportion all the words, you apportion all the words, the impairment loss to who? To who?
The
To who?
order to the parent.
To the parent. Good. So let's go. 5. The fifth one is what? Consolidated what? Retained earnings. Consolidated retained earnings of the parent. Okay, so here, please, what is the what? Balance brought down. Check. Profit and loss, what do you call it? The statement of financial position, check. Check. The
1435.
aha. Retained earnings.
1435.
Okay, that's fine. 14.
2032.
Okay.
1432.
1432. Right? Now you come here, you come and do your sharing. All right. So here you say what? Share of what? Post acquisition what? Profits. Yeah, one, you will pick mama. Mama, the profit is how much? 960. Multiply the parent is having how many stake? What's the stake of a parent in what? In mama.
Mama 60.
Parent, mama is how much?
60%, sir.
60%. But let me show you one thing. Let me show you one thing here. Let me show you one thing.
Thank you.
Let me show you one thing here. Come here. The net asset, come here. Have you seen the net asset? Please, have
Yes,
you seen the
sir.
net asset? Have you seen the net
Yes, sir.
asset? Have you seen the net asset is part of what? What do you call it? It's part of the post-acquisition profit that we are going to share. Have you seen it?
Yes, sir.
Both ends. Have you seen the revaluation surplus? Have you seen the revaluation surplus in both ends? Have you seen it? Good.
Yes. Yes.
Aha. When we share this net post-acquisition profit to form part of retained earnings, when we share this one and this one to form part of a retained earnings, your account will still balance. Your account will still balance.
Okay.
However, we will not have revaluation surplus back in the book again. Do you understand?
Wow.
Because yeah, we will not have the revaluation surplus of what? Of mama, what do you call it? Of the group back in the what? In the group. And again too, and again. Revaluation surplus is not a true earnings. Do you know also that? Do you know that it is what? It is a line item under equity. Do you know that? I'm saying that, have you seen this revaluation surplus here? Have you seen this revaluation surplus here?
I can hear you.
Good. This revaluation
Yes.
surpluses, this revaluation surplus, you know that all of them, they are line item under equity. Both revaluation surplus and what retained earnings are both line items
Retain
under,
earning.
all of them are under equity. Do you understand? Now,
Yes,
when
sir.
we pick the increase in value and share it under retained earnings, your account will still balance, but will not, it will be double counted, but it will not. When that happens, it means we've taken a portion of revaluation gain here and then added it to a revaluation retained earnings here. What doesn't make accounting sense? Because, by the way, revaluation surplus is not a true profit. You know that. But when asset increase in value,
Sure.
until the asset is sold, it is not a true earning. So why don't we separate what is true earning that will go to retain earnings and then maintain the revaluation gain or loss and the revaluation surplus account? Do you understand? Though
Okay.
if you forget and you share it, your account will still balance, by the way. You understand? But it doesn't
Sure.
make accounting sense to do that. So here, when you are coming to share, if there's a revaluation surplus in a net asset and you are coming to share under the retained earnings account, remove it from it. Then you share the rest. That's all. So
Best.
when you
Okay.
look at this one, the total post-acquisition profit was 960. Then the retained revaluation surplus was 640. You less it, then you multiply by the percentage of what of the parents and mama is how much? 60%.
60%.
Right? Then when you come to baby too, there's a revaluation surplus there. That one too is how much? That one too is what? 131.6. And there's a surplus of 40. You remove that one too. Right? So this is 131.6 minus 40. Right? Multiplied by baby. What is the percentage of what? Parents and the baby? 48%. Right? Okay, so when you do, what do you have?
One is 192.
The first one is what? 192. And the second one is 43.96, right? Okay, that's fine. Okay. Then
Yes, sir.
what shall we share? Let us share also what? Impairment loss, right?
Impairment.
Okay.
Impairment.
You share impairment. Now when you come to impairment, mama, there was an impairment of how much? 40. Right? They multiply by parent. Parent has stake in mama how much?
Parents stake in mama.
It's
60.
how much?
60.
60%. When you multiply, what do you have?
6424.
Okay, so because it is impairment, you will less is 24, right? Then when you come to baby impairment, what did I say? It is
It
proportionate
is
method, or
proportional.
100% will be brought here, right? And then the last
Yes,
one is
sir.
what? Unwound discount. You remember what I said unwound discount or finance cost will be. You see, it was mama who acquired baby. So they are going to share any impairment loss that comes with it, right? Or there was
Yes, sir.
deferred consideration, which is 416 minus 320. And parent has how much stake in what? In the mama who acquired 60%.
60%.
So what do we have?
57.6. 7 point.
57.6. Okay, you put it bracket because it's a cost to the company. Any
Okay.
other additional thing to do? No. 1566.
66. Yes. 0.36.
Okay, so that is it about that. Now, let us look at the sixth one. I told you about revaluation of what? Of the surplus. So you say, well, consolidate revaluation surplus. Okay, so you have it here. Now go into the book. So balance brought down is how much? Check. Balance brought down of what? Of consolidation from the book is how much?
2,400.
Good. Because you need to do it. 2,400. You need to do it, right? You need to, because you already have a revaluation surplus already existing in the book, right? So how do you consolidate that with the subsidiaries? Please, do you understand? Okay, so
Yes,
you
sir.
have to consolidate that one in addition. Okay, you bring the
Yes,
opening,
sir.
you opening the opening balance of the parents. Now, when we look at mama revaluation is how much?
960.
Okay, mama revaluation is what? 960, right?
Uh-huh.
So
But the
what here?
parent is 2,400.
So what here? You say you remember I told you about revaluation of what of the, so you can say what share of what post acquisition what
Profit.
revaluation surplus.
Mm-hmm.
Right. So here I didn't want us to share the what? The revaluation against the what? Against the retained earnings here. This I'm talking about this. Where is it? I'm talking about this. Are we saying this
Oh, net asset.
640? Are we saying
The
this
six.
640? And then this
Uh,
40. I don't want us to share it, the retained earning, because
Retain earning.
that's not where it belongs. It belongs to, because they are not true earnings. So you cannot add it to earnings. You understand? So it must have a standalone what? Line item and equity. You understand? And which is revaluation surplus. So we already have parent having what? Revaluation surplus. So why don't you add it to the parent revaluation rather than you are adding it to the retained earnings? The reason why we don't have to share it to the retained earnings. Do you understand?
Yes, sir.
Aha. So rather we should share it to the what? To the parent evaluation surplus. So here you have what? Mama, which is 640 multiplied by the parent has 60% on that. Then when you come to also baby, that one too is 40. You share it what? Parent has how much stake in what baby? 48%. Then you add it rather to what? Revaluation surplus rather than the retained earnings. Though when you see the funny thing is that when you share it and add it what to the retained earnings value what will increase by that. You understand? Your account will still balance, but you see it is not the right accounting thing to do because the asset is still sitting in your books. Please are you with me? You've not
Yes,
sold
sir.
it yet, so you cannot just go and add it to thing and it should rather fall on a revaluation surplus. Okay, do the math.
First one is 384.
3
84.
and second one
19.2.
okay, 19.2. Okay, so when you add, or what do you have?
2803.2. 2803.2.
Okay, so that's what you have for revaluation surplus. Now here, watch here. There are some items that are two in the what in the, so you consolidate them. You have one goodwill,
Okay.
right? So goodwill under mama, baby. What are they, right? So under mama, what is the goodwill? What is it goodwill under mama? Mama is
Mama
960
is 960.
and baby is how much?
Baby is 275.68.
275.6. Add it. Then you come to NCI. Mama, baby. Give me.
NCI.
No, give me the total for goodwill.
Our goodwill is 1235.6.
1235.6.
0.6.
Give me NCI. Mama, NCI is how much?
Mama NCI is tentative. Okay. Mama 787.2.
Okay, 787.2. Okay.
Yes.
787.2. Okay, baby is how much?
Baby is 954.5.
Okay, you add it.
1741.7.
17.
41.7.
Okay, so we are done. So let's go. Now let's look at property, plant, and equipment. Is there any fair value of an asset? PP, is
Yes,
there any
sir.
fair value?
No, 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 no.
There's no fair value, then you add it up.
Okay.
What do you have?
6792.
6792. Now let's go to investment. Is there any adjustment that has to be done on investment? Yes.
And
What?
the cash.
Yes, the cash. There's what? There's some cash that are used to pay for the this thing. So let's go. Okay, so it says 6792.
92.
Okay, now you said there's some cash. So here, what cash are you talking about? Then this one, all you have to do is go to the purchase consideration, the transaction purchase consideration. Have you seen the cash that we used to buy the company?
1800.
You understand? 1800. Then you come and less it. 1800. Okay. Then which one again? Did we spend any
Oh,
cash for any investment?
Baba, baby,
Baby, that one too is 1536.
36.
You come and less that one too. That's all. So these are the cash transaction in the person. So you less it. What do you have?
3024.
3024.
Yes, sir. We know goodwill.
Now, let's go. Goodwill, we know. We calculated goodwill. The total goodwill is how much? Give me.
1235.
Point what? So goodwill. 1235. 1235.6. Is that it?
Yes, sir.
Okay, now let's go to, in the question, there's a brand. Have you forgotten brand? There's a
Yes.
brand under
Yes.
baby. Baby brand. How much? 40. Right? So you'll bring your 40 here. Then you will less the word amortization of 2. What do you have?
38.
Good. We are done with this one. Add.
11089.6.
Then let's go to inventory. When you look at inventory, do we have any provision for unrealized profit?
Yes.
Yes.
PUP.
And baby, there's what? There's
Yes.
a PUP of
2.4.
2.4. You will less it from what? You will less it from what? Inventory. Okay. Do we have any additional inventory? What do you call it? No, we don't have anything that come
We
here.
don't
So
have
only one.
any.
Add it. What do we have?
1475.6.
1475.6. Let's go to receivable. Receivable, there's nothing about receivable. Add it.
1376 plus 416 plus 100. 1892.
1892. Okay. Now let's come to cash. There's nothing here to
Yeah.
talk about cash. There's no transit. There's nothing. Add it.
536.
536. Add them.
3903.6.
Which one is that? This portion is 17,456. Have you seen where you had it wrong?
I've seen it.
Uh, okay, so add the assets together. What do you have?
So what was your total? 41.
Uh
41. 73. Okay. 26. Thank you.
no, add it here for me. Plazas.
41. I am adding. 11089.6. 15263.2.
15,
3.2. So do it and let's see. Your summing.
15,
263.2.
263 point what? Point two. Like this.
Yes. Yes,
Okay,
sir.
good. Now let's go to equity. Revaluation surplus.
Revaluation surplus.
Okay, so the revaluation surplus is how much?
2803.2.
Okay, so this revaluation surplus has have you seen?
8
230.
2803.2.
Okay, 28. 3.2, right? Okay.
Yeah.
I told you
Yes, sir.
that this revaluation, if we don't share it, if we don't bring it together with revaluation support, here would have been, listen, here would have been 2,400, right? And
Yes.
the revaluation,
Alone.
alone. So, and the revaluation gains that we had in the what, in both
The
subsidiary and subsidiary,
403.
it would have been
403
added, it would have been added to the retained earnings here.
earnings.
And
Yes.
it will say balance. But I'm saying that it doesn't make accounting sense. Because you should rather come and add it to the valuation surplus here. Do you understand? Rather than to
Okay.
add it to a retained earning, because it is not a true profit or earnings to be added to the retained earnings. Okay.
Okay.
Now let us look at the retained earnings. What is the retained earnings value?
1566.36.
Okay, so retained earnings is what? 1566. Okay.
.36.
1566.36.
66.36.
Okay. Now let's look at non-controlling interest as we added. How much is it?
Yeah, we had
1741.
1741.7.
Okay. Okay. So you add this. What do you have? 10, 1, 1.
Triple one. 1.26.
Okay, let's look at payable. There's nothing here. Taxation, there's
Yeah.
nothing. So add them.
Payables 2280.
Okay, taxation.
2476.
Okay, deferred consideration. You remember I told you the deferred consideration. You remember deferred consideration we were talking about?
Yes, sir.
Okay, so they were having deferred consideration of what? 320. That's what they told us, right? And there's what? Unwound discount. You remember?
Yes.
Okay, so the unwound discount was 416 minus 320. How much is it?
416 minus 320. 96.
96. Okay, so you add out this one too. What do you have?
5172.
5172. Okay.
72. Yes.
5172. Yo.
Yes, sir. Or
I don't know. When I
no, sir.
just look
Check
at
it
it,
for me.
when I just
22. The two will give me 15,283.26.
no, check the retaxation, check the taxation again, because I think that's where you have the problem.
The problem, okay. Taxation is 1296 plus 1128 plus 52.
32 or 52.
So is it 32? Let me see. 2456. So 5152.
Okay,
Total
so
is 5152.
when you add this, what do you have?
15263.26.
15, 2,
263.2.
uh, point 2.
15,263.26 is the same thing.
Okay, so that is it about that.